Coca-Cola is one of the most widely recognizable brands in the world. So, understandably, a lot of investors are interested in owning Coca-Cola stock. But what's a fair price to pay for this business? I'll answer that question in this video. I'll share with you my intrinsic value per share calculation utilizing the discounted cash flow model. I'll share with you precisely each step how I calculated the value so you can get an understanding of how I arrived at the fair value for Coca-Cola stock.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so my fair value calculation for Coca-Cola stock is $102 a share. I also did another scenario where the fair value came to $65 a share. But my base case is the higher valuation. And I'll share with you precisely how I arrived at the $102 price target and how I arrive at the $65 price target. So let's start with the free cash flow forecast. This section shaded in green was retrieved from ticker.com, and these are the forecasts from the analysts that are following Coca-Cola and what they believe the company will deliver in free cash flow over the next few years. The analysts on Wall Street are bullish on Coca-Cola's prospects, forecasting free cash flow will grow from 4.6 billion all the way up to 14 billion in 2028. The factors that are boosting Coca-Cola's free cash flow are most notably price increases that have not resulted in decreases in demand for Coca-Cola's products. Coca-Cola has raised prices consistently over the last 3 to 4 years, ever since inflation resurged following the pandemic, especially as trillions of dollars of fiscal stimulus went out to economies worldwide. Coca-Cola has also benefited as people have spent more time and money away from home since the economic reopening in 2022. Coca-Cola has a stronger market share in areas outside of the home. Think of things like restaurants, theme parks, movie theaters. Coca-Cola has a stronger market share in those categories than it does in categories for taking home beverages. And so as people have spent more time and money away from home, that's benefited Coca-Cola, and that trend has continued longer than most analysts expected, longer than I expected. I thought by now people will have, exhausted that pent-up demand to get outside of the home and spend time and money outside of home. And especially as the prices of everything when you go outside of your home, whether it be transportation, parking, food prices, restaurant prices, concert prices, movie ticket prices, theme park prices, everything has gone up by so much that I thought people would run out of money to spend on these areas and they would revert back to spending more time at home, entertaining themselves with lower priced options like a Netflix subscription and maybe a Domino's delivery for consumption at home. But that hasn't been the case. Demand for activities outside the home have continued to remain robust, and that's been great news for Coca-Cola. Between 2028 and 2034, I forecast that Coca-Cola's free cash flow will grow from 14 billion up to 26.7 billion in that year. From that point onward, I forecast Coca-Cola's growth will slow down to the 4% longer-term terminal growth rate, and that will result in a terminal value for Coca-Cola's free cash flow of 758 billion. When we discount all of those cash flows back to the present, the value of those free cash flows totals $470 billion. The weighted average cost of capital I used for Coca-Cola is 7.7%. I've applied a cost of debt of 6% for Coca-Cola, a cost of equity of 8.22%. I used the capital asset pricing model to calculate the cost of equity with its beta of 0.62 according to Yahoo Finance, risk-free rate of 4.5%, and a market risk premium of 6%. Coca-Cola's market cap is $275 billion and it has debt of $46 billion. So I've given them a target capital structure of 25% debt and 75% equity. Remember, every business is financed through debt and equity. You either borrow money or you use existing funds and sell shares of the business to raise capital for a business. Coca-Cola uses primarily equity to fund its business, and it doesn't go out and ask for more money from investors, but what it does is retain some of the cash flows that it earns. It doesn't pay out. It does pay significant sums in dividends, but it doesn't pay out 100% of its cash flow in dividends. It keeps some of that cash flow. And that's an example of a company using equity to finance its operations. That's equity that owners are entitled to, but instead of Coca-Cola giving it all back to owners, it keeps some of it to reinvest in the business, to update the manufacturing facilities, to help out its suppliers, to build out their technologies and capabilities so that they can continue bottling the company's beverages and their distribution partners, all of which Coca-Cola has done a phenomenal job of maintaining its quality and competitive advantages. So the company's value of operations were 470 billion. When we add the company's cash and subtract the debt, we get a value of equity of 441 billion. If we divide by the number of shares outstanding, we get an intrinsic value of $102. So that's how I arrived at my intrinsic value calculation. Remember, the current market price is $69. So according to my calculations, Coca-Cola stock does appear to be undervalued. Now, it does have a very low beta of 0.62. The average beta is 1. When a company has a beta of 1, it means that its stock price will move just like the S&P 500 index moves. So if the S&P 500 index moves up by 1%, Coca-Cola stock would move up by 0.62%. So it's a less volatile stock than the S&P 500 index. But if I were to raise the beta, if I were to adjust the beta higher and look at the intrinsic value with the higher beta, the intrinsic value per share would be $65, which would mean that the share price is fairly valued instead of looking like it's undervalued if the beta was adjusted upward. But historically speaking, the beta is 0.62. And looking ahead, I do believe this business is less risky than the average business in the S&P 500 index. So I do believe it earned a lower risk premium and a lower beta than the average stock in the S&P 500. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.